If we're talking about iBuyers, one of the first questions a lot of people have is about the risks. This is inherently a pretty risky model because these businesses are buying houses. They have those houses on their books, they own them, and then they need to sell them. So the biggest risk there is kind of what happens in a market downturn. And the short answer is we don't know. And none of these iBuyers have kind of gone through a significant market downturn yet, so we don't know for sure, but we can make some guesses, we can make some assumptions. So first off, yes, this is a big risk. If you're buying hundreds of houses a month in a market like Phoenix and the market starts to cool, you could be in trouble, right? These iBuyers, they're going to own a lot of houses. They might have to reduce the price that they're reselling them for. They might have to increase their fees. They might end up holding these homes longer than they would prefer, which is going to increase their holding costs. So there's quite a bit of consternation about, okay, what happens in this downturn. But it is worth noting that these big iBuyers, they are active in a number of markets, and the markets will most likely not all go down at the same time. And they'll be able to see this stuff coming. So the iBuyers have a number of levers to pull. They can raise their fees, they can buy less homes, they can just kind of get rid of inventory by reducing the asking price. So there's stuff they can do, but really we've yet to see kind of a major downturn and what impact it has. But that's definitely kind of the primary risk with this model. Secondly, it's kind of worth noting just the general unit economics of an iBuyer. So, iBuyers make money, they generate revenue two ways. The first way is from their actual service fee. So, in general, if you use a real estate agent, you'll pay about 6% commission. The iBuyers are out there at about kind of 6.5% commission average. But it can go up. It can be 7, 8, 9% depending on the risk profile of the property. The second way they generate revenue is through the price appreciation of the home they buy. And that's simply the difference between the amount they buy a home for and then the amount they sell it for. And there is a difference there. It's usually about kind of 5% or maybe $10,000. That's where everybody's averaging. So it's a little bit. It's not a typical margin that you'd see on a home flipper, where an investor kind of puts $40,000, $50,000 into a property and sells it for 20, 30, 40% more than they bought it for. The idea behind iBuyers is to give people fair prices for their property, and I think that's proven out by how small that difference is between what they purchase a home for and then what they sell it for. So those are the two sources of revenue. But then all the expenses are kind of what you'd typically expect. There's agent fees, there's holding costs, there's seller concessions, there's fixing up the property, mowing the lawn, putting in new carpet. All of that kind of adds up. And I think if you wanted to shortcut, the margins out of this, Zillow's been out there and they said, hey, at scale, we think this is going to be kind of a 1 or 2% net margin business. So you're looking at really small margins. And the reason, or when this gets interesting, is at volume. So kind of like Amazon, small margins, but at scale, it starts to get really interesting. I think another big question that people ask is, right now you have Opendoor, kind of the really big pure iBuyer, raised over $1 billion, versus Zillow. Who wins? Zillow, the multi-billion-dollar property portal. Kind of what are their advantages? So on the one hand, Opendoor has been at this for 4 years. Zillow's been at this for about 5 months, 6 months. So Opendoor has had 4 years to kind of learn and build up that muscle. This is the one thing they do. Opendoor does this one thing, whereas Zillow does a portfolio of different things. So they need to build up these muscles to what it takes to kind of successfully buy and sell and flip these houses. So Opendoor has definitely been in the market a lot more and learned and has built a really well-oiled operational machine. They're able to kind of move these properties really, really quick, and they're good about finding the opportunities and making that a seamless, fantastic customer experience. On the flip side, though, Zillow does have one big advantage, one big sustainable competitive advantage, which is lead generation. So Zillow has a website, they have a property portal, and millions of people go to that every day. And if you go to Phoenix right now and you look at any listing in the Phoenix market, whether it's for sale or not, there's a little advertisement that says, want to move today, want to sell your home instantly, go to Zillow Offers. And that is the beauty of Zillow being in this space, is that they have no incremental cost of customer acquisition. It's effectively free for them to advertise. And based on the numbers coming out of Zillow and their earnings calls, I mean, they're generating thousands and thousands of leads every month from people who are interested in selling their home, and it doesn't cost them. Whereas Opendoor and the other iBuyers, they have to acquire those leads somehow. They have to run advertising, whether above the line, online, or they need to kind of find those people through word of mouth in a community. And it's all possible, and I think they can do that successfully. But the other iBuyers are definitely at a disadvantage when it comes to customer acquisition compared to Zillow. And that's Zillow's real moat and real strength for this opportunity. So we're going to have to see how that kind of plays itself out. But that does bring up another really interesting opportunity, which is the seller lead opportunity. So for every lead that an iBuyer gets, especially Zillow, because they're generating so many, the iBuyer will only make a certain amount of offers. And the latest numbers out of Zillow, out of their earnings call, said they got about 20,000 leads. So 20,000 people went to Zillow and said, hey, please make me an offer on my home. Zillow only bought about 1% of those, about 200 homes. So that means you have 99%, 19,800 leads, where these are people that are interested in selling their home, but for whatever reason they didn't get an offer. Maybe their home's too old, or in disrepair, needs too much work. It doesn't kind of fit the buy box of Zillow. That's still a really highly qualified lead. Leads that come through iBuyer services are highly qualified. They want to move now. They're really interested in it. Filling out that form there's a pretty high hurdle there. They're not just sending an email or clicking a button. I mean, they're filling out several pages, 30, 40, 50 questions about their home. So there's a high degree of intent. And that's where the value out of these seller leads comes from, is suddenly Zillow has thousands, tens of thousands of people who are really interested in selling their home, but they can't get an instant offer. And I think part of the opportunity in the long game here for Zillow is taking those leads and kind of selling them or giving them to their premier agent network for a referral fee, and letting those agents talk to those people and see if they want to bring their home to the market and represent them. It's a really great kind of a win-win scenario where it's good for the agents, it's good for Zillow, and it could be good for the consumers. If it's not done in a kind of bait and switch way, but the agents are there kind of giving them an opportunity, like, hey, you want to sell your home, can't get an instant offer, but if you want to bring it to market, here's what I think we can do for you. And then, the last question that a lot of people ask is, well, what does the future look like for iBuyers? Is this 50% of the market in a couple years? I've done some calculations in Phoenix where everybody's been around for 4 years, and the market share is kind of mid-single digit percentages of the total market, and that's after a couple years. So I think there is a particular niche here that iBuyers fill, and there are going to be a lot of consumers, hundreds in any one market, and Opendoor, the biggest, probably buying a couple thousand homes a month nationally. And as these companies continue to expand nationally, there'll be more and more, those numbers will just get bigger. There'll be more and more people that are interested in this. But this business model is, it does bump up against other headwinds, aside from, consumer demand. How many in the market, how many houses can you effectively kind of fix up and turn around at one time? You need contractors, people you can trust. How many carpet people, how many paint people, how many lawns can you mow in a day? There's going to be limits. There's going to be limits there, and then capital access to capital might be a limit at some point as well. But I think it's important to think that to remember that the consumer demand is not the only limiter to growth here. There's really a number of factors. So me personally, right now, what I'd say is I think that mid-single digit percentage market share is kind of reasonable. I think that's where we're at now, and as these companies expand nationally, they'll probably get to those type of levels in those other cities, at least for the foreseeable future. So even that scale, it's still a multi-billion-dollar business. It's still big, but I don't see it kind of wholesale revolutionizing the real estate space overnight in a hockey stick curve kind of way, or in a way that Uber's done with ride sharing. So I think it's slow and steady growth, and it's definitely hitting a need, but it's not going to be an overnight revolution.